we go. It's going now. All righty. Thank you. Okay, we'll call the meeting to order. Good morning, everyone. My name is John Von Paris, and I am the chairman of the MDTA Finance Committee. I hereby call the meeting of the Finance Committee to order at 9:04 a.m. In accordance with the live streaming law, this meeting is being conducted via video conference and is being live streamed on the MDTA Finance Committee webpage. All members will have their video active during the entirety of the meeting. To minimize background noise during the call, I would ask that everyone on the line please mute your phones except when speaking. I ask that those who are presenting or answering a question to please turn your video and audio on when speaking. When you are done, please turn your video off and put your audio on mute. There are no members of the public, no elected officials, and no media who have pre-registered to comment on this morning's meeting. At this time, we will begin with agenda item number 1, the approval of the minutes from March 9th, 2023. Is there a motion to approve the minutes as presented?
So moved.
Okay, we have a motion. Is there a second?
Member Ardinger, I'll second.
Okay, thank you. A motion and a second. All those in favor?
Aye.
Aye.
Okay, opposed? Okay, motion carries. The minutes are approved. We'll move on to agenda item number 2, approval. This is approval item, Board Resolution 2301, BWI PFC refinancing, and Alan Garman will present. Good morning, Alan. How are you?
Great. Thank you. Good morning.
Morning.
This is a board resolution seeking delegated authority to conduct the financing for PFC bonds. In particular, this would be a refinancing of some existing debt. If you recall, we had attempted to do that last year and the market moved against us. So we have some savings that are expected again. Interest rates have come down a bit. And so we'd like to take advantage of that. This resolution authorizes about $100 million to refinance the 2012 A's, 2012 B's, 2014 bonds for economic savings, and also to refinance the Series 2012 C variable rate bonds to fixed rate mode. The resolution also would permit the application of up to $40 million that's currently held in the PFC Facility Improvement Fund for the purpose of reducing principal outstanding. And there's an additional springing amendment that would change the issuer for future financings to MDOT from the MDTA. And I'll go into a bit more detail about that. Of the $241 million of the PFC bonds that are currently outstanding, combined $128 million are callable or will be callable by June 1st. In terms of the refinancing savings, we're currently modeling savings of about $2.8 million for just the 2012 A and the 2014 bonds. We'd be looking at each individual maturity to see if they're economic. Some of the coupons are quite high at 5%, and then there are lower coupon bonds. They're all callable at par. So it really depends on what happens in the market in coming 2 to 3 months to determine which precisely maturities will be taken out. The cash defeasance component, we've been looking at investment opportunities in the facility improvement account, and we recognize that it would be good to use some of those funds to buy back the 5% coupon bonds. That's really the best use of funds at this point. And there's sufficient excess money in that account to cover the ongoing capital improvement plan. In terms of the springing amendment, MDTA has been the issuer since the inception of the PFC program. We have legislative authority to issue non-recourse or conduit debt. In recent years, MDOT's been granted similar conduit financing authority. And from a functional reporting lines perspective, it makes sense, administratively for MDOT to issue future financings for the PFC program. The nuance here is that we can't accomplish that all at once. We'll be introducing a springing amendment in this supplemental trust. It would spring into effect once effectively 50% of the new bondholders have voted in favor of it. And with each new financing, the bondholders effectively vote in favor of any springing amendment. Based on the amortization and the planned financings, that could happen as early as June 1st of 2029. Could happen a bit sooner if there's more refinancing opportunities, but that's sort of like the longest likely date for that to spring in effect. The resolution itself provides delegated authority to conduct all aspects of the financing within the limiting provisions or parameters of this resolution. A few of the key points again are that the call dates for the 2012 A's, B's, and C's, they're all currently callable, and the 2014 bonds will be callable June 1st. They're all callable at par. It's about 128 million. If you think about once you hit the call date, the internal rate of return or your interest cost is effectively kind of the weighted average of those coupons. So on the 2012 A's, the internal rate of return or IRR is about 4.4%, and the 2014 bonds is about 3.7. We're expecting or modeling a new interest cost for this refinancing at around 3.2%. So again, that could move up or down in coming 2 months. The expected savings as a percentage of par for the 2012 A's is about 5% and about 2% for the 2014 bonds. And in dollar terms, that equates to savings of about 1.9 million and 0.9 million respectively. The bond financing would occur potentially late July or early August if we can get things moving. In terms of the par amount, the resolution has limiting provisions. We're limited to 100 million. And in compliance with IRS regulations, the final maturity is related to the final maturities of the existing bonds. So 2034 would be the longest maturity. We would have to generate NPV savings of at least 1 million in aggregate. And again, each individual maturity must be economic as well. We wouldn't, for instance, refinance something at a higher cost. So everything would be economic. The bond sale must occur no later than December 31st of this year. And then the executive director and CFO must come back to the full board at the first meeting after the sale date to report on results. Just wanted to briefly show the two tables that I'd included. They're on page 4 and 5. If you look at the bottom of there, I have some highlights on page 4. The yellow highlights are the principal maturities that are callable for the 2012 A's. They're a good example. And the next column over that's highlighted in green, you can see the big premium coupons that we'd be able to take out. They're mostly about half 5% coupons and a half 4% coupons. And then if you look at the far right, you can see in blue the annual debt service. And I wanted to show on the next page, page 5, what that savings looks like. In the second column of page 5 in the savings table, you'll see the prior debt service. That's basically the same debt service that you see on the prior slide that was highlighted in blue. And if you look at the prior net cash flow in the middle, it totals about 34 million. The refunding debt service projected at prevailing rates would be about 32 million. So the difference between those two columns is our savings on a nominal basis, about 1.88 million. So that's essentially summarizing what we model continuously, and these numbers will change, with the market in coming weeks. Are there any questions?
I do have a question. So thanks for that, and clearly any type of time we can take advantage of the savings, and and it coincides with when we can call the bonds, I think is great. The springing amendment, just can you clarify a little more how that's going to work? So you said, because it sounds like you said that the issuer will become MDOT as opposed to MDTA at some point, and that's for all the bonds or just for these future issued bonds? And I just don't understand how that works. How all of a sudden they step in our place.
It's kind of an unusual situation. So initially with this financing, we're still the issuer and we would remain the issuer for future financings until potentially June of 29. And then, basically with each financing, you issue a supplemental trust agreement, and those supplemental trusts, contain new provisions or new amendments. So effectively, when the underwriter buys the bonds on the sale date, they vote in favor of all the amendments that are included in that supplemental trust. So until we get 50% or slightly over 50% of new bondholders to vote in favor of the amendment, it does not become effective. So, for instance, with this financing, it's just a springing amendment that's not yet become effective. We would remain as the issuer of the bonds. And it's not until 2029 that MDOT would suddenly become the new issuer of all future bonds, and they would also take over as issuer for all of these old bonds effectively. We administratively manage this program, with oversight from the board. So we have control over for instance, the PFC improvement account and the bond service accounts. The invoices that are paid for construction on the PFC funding all flow through the MDTA. Components of this financing get reported on our financial statements. So there are a lot of elements that would sort of cease once we get beyond 2029. And Deb, I see you're on. Did you want to add something?
No, I mean, all I was going to add, Member Rosen, is that as part of our statute, we had the responsibility of being a financing arm for MDOT. And at one point in time, MDTA was the only transportation agency that had the authority to issue revenue bonds. A few years ago, a statute was introduced that allows MDOT to issue revenue bonds. So, and so, with their with their management of the airport, they're looking to start, assuming responsibilities for these issuances. At the end of the day, we're here to support the department in however they need us to. This is a shift that they're looking to do. We fully support it. And like I said, previously, we had issued these bonds because we were the only one with the statutory authority to do so. And now they have the ability to do that.
There was one other recent occurrence was the PFC the BWI parking bonds. We were the issuer of that trust, if you all recall as well. In recent years, the MDOT has been issuing general airport revenue bonds for MAA. So there's a new credit at the airport, and they rolled in the parking revenues into that credit. So we're no longer the issuer of that. That trust completely closed. In this instance, the PFC trust is not going to close. It's just changing the issuer over to MDOT over time.
Okay. So for that parking financing we did, we're no longer involved with that?
Exactly. The trust is completely closed. The bonds were fully paid off.
Right.
And the revenues from the parking garage now flow into a general airport revenue bond credit. So it's a sort of a pooled trust. So there are other lease revenues and things that are flowing into that pooled trust. And that was issued by the MDOT.
Terrific. Thank you.
There are no further questions. We're seeking approval.
I'm sorry. I'm sorry. Yeah.
Great.
I'm sorry, Alan, thank you for that explanation. And just so I can fully understand, so the resolution, and I appreciate the fact that it gives you some flexibility in regards to, do you issue bonds or do you go via a bank loan, if I understand this correctly? I'm assuming, again, just for my own information, you're going to be watching what's happening with the interest rate, and that's where we're going to see a decision made as to which way to go?
That's correct. Typically, for small financings, or not typically, it's occasionally cheaper to go with a direct bank loan where they'll buy like a small financing of short-term bonds, and it would be cheaper than going and doing a normal muni bond issuance because you can avoid, creating an official statement. At times you can avoid credit ratings, the cost of the credit ratings. So there's some efficiencies, and they may be able to offer lower financing rates. Currently, bank loans are more expensive than doing a municipal financing, so we're not likely to go to that way, but the resolution is written broadly enough so that we can kind of explore, that possibility or continue to explore it. But at this point, it's likely to be, municipal bond financing because that's the cheapest, route for the refinancing.
Interesting. Thank you.
We've done some bank loans in prior years. We've refinanced our toll revenue bonds. We refinanced Garvey bonds with bank loans, but they've typically been in certain types of markets where the banks, have had lower cost of financing, and also they tended to be smaller financings as well.
So in Member Arnger, in the resolution, when there's multiple options available, we need to be able to give ourselves the flexibility to shift quickly, because the market can change that fast. And if we waited a month or so cycle to come back to the board for approval, whatever opportunity existed may have evaporated by time we got that approval. So that's why we set the resolution up in this manner. We set the parameters up front, what the options are, and then we close it out by coming back to the board and demonstrating that we operated within the parameters that the board gave us authority to do so.
All right. Thank you. Thank you both for that explanation.
Okay.
So we're just seeking a recommendation to move forward to the full board for approval of resolution 23-01.
I guess first I want to thank the board members for their questions, very good questions, and for the answers provided by Alan and Deb. Thank you. So is there a motion to advance this item to the full board for approval?
So moved.
Okay, Member Carroll, and as a motion, second?
Member Ardinger, I'll second.
Okay, we have a motion and a second. Is there any further discussion? Okay, if not, all those in favor?
Aye.
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 Opposed? This motion is approved. Thank you. Alan, I guess you're still up on the next item.
Thank you.
And this is item number 3, the approval investment committee report, quarterly update on the investment of MDTA's funds, and Alan and Clayton will present. And this is the last approval item on today's agenda. So, Alan, you're up.
You turn to slide 2. It shows the agenda. So we're providing a market update discussing policy compliance and investment performance relative to our benchmarks. The key points are that the portfolio is diversified and remains in compliance with the investment policy and trust agreement. Our matched funding accounts are benefiting from higher prevailing rates for short-term instruments, and our total return accounts, the strategy should remain consistent despite short-term return volatility associated with the rising rate environment. And our multi-year returns for these long-term reserves align with our financial forecast. That I will turn it over to Clayton for slide 3. Clayton, we're not hearing you. I think your mic may be off. Oh, I can hear something now. That's a good sign.
Alan, until Clayton, until we can hear Clayton, do you mind moving,
Sure.
starting his slides? Oh, we can hear you now.
Does this
Okay,
work? Okay.
It
There we
does.
go.
I
Thank you,
apologize.
Clayton. Thank you.
Thank you for your time. I apologize. So on slide 3, we want to highlight a couple of items. I guess first at the top, if you'll notice at the table, we've got most recent data for GDP, unemployment, and inflation. And, the takeaway here is that inflation has moderated, is in fact coming down a bit, and at the same time remains sticky. And the Fed has expressed concern about the stickiness of inflation. And this was corroborated or supported by CPI numbers, which were issued yesterday, as well as PPI numbers, which came out today. A little bit of improvement for both year over year, ex food and energy, but still there's a sticky situation in terms of inflation. So despite these interest rate increases that we see in the graph, there's still some challenges ahead, and members of the Open Market Committee have come out and said that even further increases may be necessary, whereas a few weeks ago they had begun to back down. You see on that graph also that we've got a situation, and we can talk about this a little bit later in the presentation again, but we've got a situation where the interest rate or the yield curve is inverted. And so that presents some challenges as well as opportunities. Another note is that employment is extremely low given these increases in interest rates. And, there's anecdotal information, especially in the tech community, where unemployment or layoffs have gone up massively, but still the measures used by the Fed and the market indicate that unemployment is extremely low and has not crept higher at all. The Fed remains committed to its 2% inflation target. They also are committed to quantitative tightening, which basically means they're offloading assets from their balance sheet to the tune of $95 billion a month, $60 billion in treasuries, and then another $35 billion in agency and agency mortgage-backed securities. Moving on to slide 4, we wanted to introduce this notion of core PCE, which is the Fed's preferred measure. And as you see in the chart, it has moderated, but it hasn't declined to the extent that has been targeted or hoped for by the Fed and the market for that matter. What we have observed is declines in raw commodity prices over the past 9 to 12 months, where raw commodities such as oil, crack spreads, industrial metals, prices have declined anywhere from 25 to 80%. There's a hope that feeds through to these core PCE measures, ex food and energy, but that's not necessarily always the case, especially as a bigger component recently has been services. Moving on to slide 5, we show a pie chart demonstrating the allocation of the portfolios, all of the assets of the agency. And of note here is the large position that we have in agency securities, $630 million. We'll see a bit later that this is primarily focused on the match funding accounts. and even more granular in the Federal Home Loan Bank positions that we have. Are there any questions at this point? Okay. Moving on to slide 6, as I just noted, the match funding portion remains very low maturity inside of a year. The entirety of the assets, the match funded assets, are within a year of maturity and are almost 2/3 of the agency's portfolios. The orange bars there demonstrate the maturities of the long-term reserves, the total return accounts, and as you know, or may recall, we're permitted within the M&O and the general account guidelines and policy to go out as far as 15 years. Moving on to slide 7, we in fact show the maturity profile for the general and the M&O accounts, the total return accounts. And again, we are within the guidelines and the policy. The general account, as I mentioned, can go out to 5 years, and the M&O account can go out as far as 15 years maturity. And then slide 8, we have our compliance report. And the takeaway here is that we are indeed in compliance with all of the policy and the guidelines. We measure this in several ways. One is maturity, and one is exposure to the various sectors and subsectors where we're permitted to invest the assets or the financial assets of the agency. As I noted earlier in the pie chart, a significant percentage of the portfolio or the assets are invested in agency securities. And if you look there at the bottom, you'll note that Federal Home Loan Bank is the predominant exposure that we have to the agencies. And that's obviously going to be a function of safety of principal, preservation of capital, but it's also a function of return. And we've seen the best opportunities to invest the financial assets in the Federal Home Loan Bank space. We're within guidelines. We're permitted to go up to 50%. And we're not going to use that all of the time, but we appreciate the opportunity to use or to have that mandate. And at various times we will use it. And so I think a takeaway here, or another takeaway here, is that we don't use the permitted limits all of the time, but there are occasions when it makes all the sense in the world to ramp up exposures or to minimize exposures. And just to highlight, this is for the period first quarter calendar year of 23. The second page of the compliance report again shows that we're in compliance. We've got exposure to a variety of sectors, subsectors, and we use that. We have recently, this second quarter of the calendar year, increased our exposures to municipals as we've seen opportunities, high quality municipal debt, and we'll take advantage of that as occasions arise. On slide 10, we're seeing the dealer trade allocation table, and this just will give you a sense of how we're allocating the trades to the dealer community. We do most of our trades on a competitive basis, and so this demonstrates that for the most part, Wells Fargo, FHN, and Bank of America are the most competitive. We do occasionally allocate trades such as discount notes using judgment, and our goal there is to make sure we've got a broad universe of dealers that we can work with. And so we do occasionally allocate to other dealers who may not be as competitive when we go out to purchase something on a competitive basis. Toyota Motor Credit, we do that directly with the issuer because that's how they function, and so that's why you see them listed there third from the bottom. I'd also highlight that most of the activity is in purchases. And so what this implies is that the securities roll off, they mature. We're not buying and selling. For the most part, we're purchasing and we're letting securities roll off. And so that lowers our transaction costs by waiting for maturities. Moving on to slide 11, another way to look at the match funding versus the total return. Again, about 63% or 2/3 of the agency's financial assets are comprised of match funded inside of 1 year maturity securities, and then the total return are longer term investments that are there for reserve purposes. Moving on to slide 12, I'll turn it over to Alan.
Alan, you're muted.
There you go.
Thank you. So on slide 12, we have outlined our two strategies, sort of broad strategies. One is matched funding for our capital, operating, and debt service accounts, and that's simply investment maturities that are matched to precede or coincide with our expected spending. And then we manage the two longer-term reserves for total return. The key element of the total return accounts is that they're longer durations, so they tend to benefit from higher average annual returns when viewed over multi-year periods, but they'll experience greater return volatility associated with the mark-to-market moves relative to shorter-term indices. The M&O reserve has staggered maturities out to 15 years and a duration of approximately 7. The general account has staggered maturities 0 to 5 years with a 3-year duration. If we turn to the next slide, slide 13, we typically talk more in these quarterly meetings about the total return accounts because of the return volatility, but we have a bit of an interesting story for a matched funding account this quarter. The key goal in these matched funding accounts is really to immunize the portfolio against interest rate risk. And we have a secondary goal, and that's to minimize the net carrying cost of debt. So in the capital account, we normally have monthly flows of net operating revenues that come into the account, and then we simply invest those monies to coincide with the expected capital spending outflow. And then we had a bit of an unusual flow on February 1st, where we drew the $200 million TIFIA loan, and that was to reimburse ourselves for prior expenditures. So those monies that came in were invested on that day and then fully invested by the next day, by February 2nd. And if you look at the two tables in the middle, the table to the right shows you the specific investments that we bought. They have maturities that were mostly in the November, December time period. And the table to the middle left summarizes, the results of those investments. So the financing rate for the loan was 2.89%, and the weighted average yield on those investments that were made was about 2% higher than that. So that 2% in terms of dollar terms equates to about $4 million of net revenues in that particular account. One of the interesting elements that we were looking at when we're making these investments is that we're in an unusual rate environment, and you can see that in the lower table there and chart is the curve is inverted, meaning that in the short term rates are actually higher than longer term rates. The projected spend out of this $200 million is expected in the March to September 24 time period. So it's starting in about 12 months from when we received the funds. And when we looked at the curve, we actually made some shorter term investments to take advantage of those higher rates. And so that's why you see that they're concentrated more in the December and November time period rather than kind of stretching them out, closer to a year and a half. So we'll have some opportunities to reinvest those monies, and we'll see what the rate environment is like. But we felt as an investment committee like that was the best option to take advantage of that sort of distortion in the yield curve. And there's a bit more distortion. You can see the two lines was the lower line, the blue line was rates where they were when we received the funds, and then by the end of March, the distortion had gotten greater. And with all the talk about the debt ceiling, and I'm not sure if things will play out exactly as they had in 2011, but there were a lot of sort of spike in rates on the short end, and actually there was a flight to quality for longer term bonds. So rates actually fell on the long end. So that's something that we're looking at, both for this account and for the total return accounts. If there are no questions on that particular account, I'm going to turn it back to Clayton for slide 14.
Before you do that, to this particular slide, we've talked some about drawing the TIFIA loan, and we had mentioned before when we presented the financial forecast that we drew that loan a year sooner than what we had originally planned. This is the reason why, because on the table, you can see our financing rate, what are we earning, and therefore what are we making? What's our profit by drawing that loan early?
Thank you.
Thank you. It was a good decision. Appears to be. Okay, well, anything else?
If I might just go quickly through 14, is that okay?
Yes.
I didn't mean to cut you off, Deb, if you...
Oh, no, I was saying Clayton.
Okay, so slide 14, we show the performance for the match funding and the total return accounts there on the top table. You notice that maybe it's better to highlight the chart on the bottom right there. You'll notice that the performance has turned dramatically. Back on the earlier slide, I think it was 3, we showed that rates have stabilized, and in fact, as Alan mentioned during his PFC presentation, they've come down a bit. And so that's reflected in the returns here, where the 1, 3, and 6 month returns have come in very strong and positive. We're still experiencing some roughness on the 12-month returns, but those will turn here shortly as well, maybe in the next couple of quarters, as long as rates remain stable to decline. Again, I mentioned earlier in the presentation that the Fed is coming around to the fact that they may have to increase rates yet a couple of more times, and so we'll see how that plays out. We'll watch it closely, and we'll react accordingly. But we do expect performance to continue to be positive and look good on a relative and absolute basis. And I will finish there.
Okay. Thank you. Is there anything else, Alan?
Yeah, I think that just takes us to slide 15. So the investment committee is requesting the finance committee's concurrence and recommendation to move to the full board for approval of our continuing investment strategy and benchmarks.
Okay. All right. Member Artinger, you have a question?
I did. Well, thank you, Alan, Clayton, and Deb for that information. And I understand with our investment strategy, we're looking long-term, but there's 2 things floating around out there of concern. There's probably more than that, but 2 things that jump, and I don't know if this impacts or is factored in. One is if they're going to increase the interest rate, and there's any impact on the banking sector. Is there any concern there? Does that impact our strategies? And then 2, also, if there is the potential for recession and there's any type of default, particularly on consumer loans, because it looks like we've got some areas there. Do we have any concern? Does that change our investment strategy in any way? Thank you.
Let me, Member Oranger, if I could, with regard to the banks and if rates rise more, are you more specifically, are you talking about bank default, or do we have any concerns about bank default?
That's exactly what I'm referring to. Yes.
Okay, so Bank of America, is currently the bank. We'll talk about a bank change in the future, not due to any risks or any concerns or anything like that. It just contractual. We'll talk about that in a future finance committee meeting, a shift that we're going to make. But regardless of what bank we utilize, 100% of state funds, and it might even be like 110, but please don't hold me to that. Is collateralized. There's securities that they are required to hold based on state deposits. So it's not just MDTA deposits, it's state of Maryland deposits in the name of the state. So there will be treasuries to back the amount of monies that the state has deposited. So that's how we mitigate against a bank default. The amount of money that the authority, or particularly the state of Maryland, has in bank, that typical FDIC insurance, it cannot come into play here to any type of benefit for us. So that's how the state and MDTA protects itself.
Thank you. But I guess even further, even if it's not our direct deposits, but some of these small banks fail, does that impact any of our other investment holdings that we have?
Alan,
I mean, we don't have direct, kind of corporate exposure. We don't own any corporate bonds. So, the U.S. government agencies have, implied backing. So we feel fairly comfortable with those. We own treasuries. We own small amount of municipal bonds and supranationals. So, we don't feel like we have a lot of exposure there. Certainly no direct exposure. We occasionally have some corporate CP exposure. We don't currently right now. Toyota Motor Credit, isn't really related, but so we feel relatively comfortable there. And in terms of like the rate environment or any big moves in the portfolio, we tend to be relatively passive and manage against a benchmark. So we don't profess to be great at forecasting where rates are headed. I'll give you an opinion, but it's very difficult for the Fed to even predict what they're going to be doing 6 months from now. And I mean, it was interesting in 2011 that, the federal government bumping up against the debt ceiling, and you'd think that you wouldn't want to buy treasuries, but, there was a flight to quality into treasuries and rates fell. So, in our portfolio, a rate decline would be a good thing in terms of total return in the near term. Longer term, higher prevailing rates help us for long multi-year returns, but they also raise our financing costs. So I think that kind of comes back to why we take a relatively consistent approach to just try to maximize multi-year returns. So I think Deb mentioned that the Bank of America money is fully collateralized at 102%. The monies that you're seeing in this portfolio are primarily at Bank of New York Mellon, and they're held in trust. So they're held in our name and not in the name of Bank of New York. So the Maryland Local Government Investment Pool holdings as well, that's managed by PNC, but those monies are held in trust just like any other mutual fund. So we're relatively insulated because of these, monies are held in trust or held in individual securities sort of outside of the bank's other holdings.
Okay. These good questions. Thank you, Member Ardinger. Any other discussion here? Any other? Member Carroll. Member Carroll.
Thanks, Member Von Paris. Building on Member Ardinger's question, for those of us who are not nearly as smart as she is, what I think I heard, and I want to be clear about, is from Alan's perspective, there's nothing else reasonably we could do from a de-risking perspective around the portfolio. And I guess, the headwinds that might be out there, unless we have a crystal ball, there's probably nothing else that we should be thinking through at this point from a de-risking perspective.
I would say,
Yeah.
Alan, give me 1 second, please. The portfolio has some risk in it, right. So we don't have a strategy to completely de-risk it. We have the long-term focus. So I'm assuming, Member Carroll, that you're asking if is there anything to de-risk while still staying in line with our benchmarks? Or are you asking, should we change our benchmarks?
We should. I'm assuming that because of how our strategy has been consistent, and I would say relatively conservative, there's likely not more de-risking we ought to be thinking through. Is that a fair statement?
Yeah, I think so. From the risks that we look at are credit risks. So we talked about how we don't typically have exposure to corporate credits except through the CP purchases, and we don't have any bank exposure currently. And, even if bank CPs were suddenly really cheap, meaning high yielding, there's no appetite to go out and buy, a lot of high yielding, let's say bank commercial paper, because that would be an indication that the market is perceiving there's, heightened risk there. And we're definitely risk averse in the portfolio from a credit perspective. And then from an interest rate perspective, it's more about volatility. We accept some volatility in the portfolio in exchange for higher average annual returns, recognizing that we'll have negative return periods, as we've experienced in, the trailing 12-month period, but we're not sort of forecasting that rates are going to be significantly higher such that we would want to change benchmarks or a major change in strategy. We really don't feel like we can forecast that, and we feel like the longer term strategy of accepting, slightly longer average maturities is a good thing for total return. If there's more market disruption, that would lead to sort of potentially higher rates for corporate credits, but it could result in a flight to quality or lower rates in the government type securities that we typically purchase. So that could actually benefit the portfolio. Hopefully that answers your questions.
It does, Alan. Thank you both.
Thank you.
Anything else? Okay. Well, then we will, if there's no other things to present or discuss, we will seek a motion to advance this item to the full board for approval.
So
Is
moved.
there a motion? A second?
Member Ardinger, I'll second.
Second. And we have a motion and a second. Is there any further discussion? Okay. All those in favor?
Aye.
Aye.
Opposed? Motion is passed. Thank you. Alan and Clayton, thank you. Deb, thank you for your participation in this, of course, and all the good work that you do. We will.
Excuse me, Member Von Paris.
Yes.
I just wanted to let you know that Member Carroll has a hard stop at 9 his time, which is 10 our time. So he'll drop off. We still have a quorum, so we can still proceed.
Okay, and we also have covered all the approval items, which is good as it relates to that, but thank you for updating me on that. We will move on. We have 4 items left and their updates. We'll go to item number 4, third quarter budget comparison for the operating budget, and Jeffrey Brown will present. Hi, Jeffrey. How are you?
Hi, good morning. Hope everybody's well. For the record, my name is Jeffrey Brown, Budget Director for the MDTA, and I'm before the committee today to provide an update or a quarterly budget versus actual update for fiscal year 2023. As of March 31st, we have spent 64% of the budget as compared to a target of 72%. Only two objects, Object 6 and 13, were above budget. Object 6, fuel and utilities, was at an 82% spend rate, and that's due in part to catching up for delayed receipt and payment of utility invoices. Object 13 was at 134% spend rate, and that's due to two reasons: the increase in the annual insurance fee plus some bad debt expense associated with facility damage, while other objects were at or below targeted spending levels. Moving on to salaries and wages, Object 1 and 2, below budget at, let me back up here. I would just kind of set the stage here. Really, the primary drivers for all of this are personnel vacancies, some reduced vehicle purchases, which are going to be shifted to the next year, and some other reduced line item spending. Now, moving back to Object 1 and 2, we're at 66%, which is below budget, and as just noted, employee vacancies account for this performance. Moving on to Object 3, communications, is at 73%, which is essentially right on budget. The two key areas are telecom, which is below budget, and that's due to vacancies, and a one-time state radio invoice, which makes it look like it's, high spending, but it's actually below budget. So we do expect this to be on budget by year end. Object 4 is travel. That's below budget at a 39% spend rate. Most of that's due to the timing of activity, and we do expect some more activity, so we believe this will come back close to budget. As mentioned, fuel and objects is above budget at an 82% rate, and as mentioned, it's the delayed billing from fiscal 2022, and the accrual that was used did not capture all those delayed expenses. These were utility bills that basically had stopped coming in for a while, so these are being caught up, and this problem has been remedied. So going forward, we should be on time. But as a result, this year probably will be above budget due to this issue. Motor vehicle operations and maintenance, Object 7 is below budget and at a 48% spend. As mentioned, this is really driven by vehicle orders and the supply chain issues that we've had getting orders in a timely fashion. As a result, we will expect to be below budget, but this cost will be shifted to next fiscal year. Contractual services 8. Object 8 is at a 61% spend rate across all these objects, which there are many. The main drivers are these: timing of invoices and activity. There is some cost shifting, as like with the vehicle orders purchases, some of the costs are shifting to next year. And there are some savings associated with some of these accounts. And there's one exception to that, which is the Easy Pass account, which is we expect to be above budget. With regards to timing issues, the key ones are engineering, which is Object 807, equipment repair and maintenance, Object 809, security services, Object 823, and other services, Object 899, which is essentially Maryland State Police. All those are expected to come back close to budget from their current rate, and that's due to, as just mentioned, really some timing and activity issues and seasonality. Moving on to advertising, 801, it's at 32% spend. We do expect some further activity. However, this is expected to be somewhat below budget, so we do expect savings. Just mentioned engineers, we do expect that to come back to budget. Equipment rental is at 58% spend, and mostly due to the timing of activity, although there is a potential for some small savings here. Equipment repairs and maintenance is expected to come back basically to budget. Again, these are a lot of one-time invoices that hit at different areas, so we do, in the long run, expect this to be on budget. Building repairs and maintenance, 812, is at 46%. In this case, we do expect some real savings, and that's because of the reduced cost for dehumidification at the Bay Bridge. And there is some cost shifting where the sludge removal activity is moving to fiscal year 2024. And as mentioned, education and training is at 34% spend. We do expect some further activity in this. However, we do expect maybe having some savings due to the reduced career development program activity. Management studies is below budget, but we do expect most of this will, or not most of this, some of this will shift to 2024, and we will have maybe some small savings in there. Mentioned security services as well, expect to be on budget. Fiscal services, 829, which is at 62%. We do expect that this will be close to budget. The IT objects, which is 841 through 869, we're at 59% currently. We will get closer to budget as there are a lot of one-time invoicing, but we do expect some potential savings here as well due to some contractual savings. As mentioned, Easy Pass Service Center cost is at a 78% rate, and really based on our latest forecast, we do expect this line item will exceed the budget, primarily for things like customer assistance plan costs. And I mentioned other contractual services, which is Maryland State Police, and we expect that to come back to budget. Supplies and materials, Object 9, is at a 54% spend rate. Overall, with one exception, we do expect this to come back to budget. Roadway maintenance materials, seasonal items, we expect that to come back to budget, as well as uniforms, which is at 53%, and ammunition at 77%, all expected to come back to budget. However, salt is hardly spent this year at 0.2% due to the mild winter, so that will be savings that we will realize this year. Replacement equipment, Object 10, is below budget at 58% rate. We do expect this to be pretty close to budget. The big drivers, other replacement equipment at 67%, and that's because of a one-time hit for the PPE equipment that was received. Additional equipment, Object 11, is at 14% spend. We do expect savings this year. Additional maintenance and building equipment, 1113 is driving most of this variance with only 3% spend, but that's because of a heavy truck delivery for the Nice Middleton Bridge that was budgeted for this year will now shift to next year. Finally, fixed objects, 13 is one of the other ones that's over budget at 134% spend rate. Excuse me. The increase is due to two reasons: the annual invoice for the bridge and tunnels liability insurance, and that's the marketplace premiums have increased significantly, and also some bad debt expense, which is for the payment for damage to facilities, is driving this variance as well. That concludes my presentation. I'll be happy to take any questions at this time.
Any questions? Okay. Well, we're up in some and down in others. It seems like it's we're up and down, but okay.
Yes.
Say that? Yeah.
Yes, we are okay. We will. I don't anticipate at this point missing the budget.
Okay, good.
Or overspending the budget. We don't intend to, or we don't anticipate overspending the budget.
Okay. Well, if there are no other questions, Jeffrey, thank you for your presentation.
Okay, thank you.
Yep. Okay, we will move on to the next item, number 5. It's an update on third quarter budget comparisons. This will be for the capital budget, and Jennifer Stump is here. Hi, Jennifer. How are you? Thanks for being here.
Good morning. I'm Jennifer Stump, the Assistant Capital Program Manager. Today, I'm presenting the third quarter review of the fiscal year 2023 capital budget versus actual spending as outlined in the fiscal year 2023 to 2028 draft CTP. This information will also be presented to the full board on May 25th, 2023. As of March 31st, 2023, 54.6% of the fiscal year 23 $556 million budget was spent as compared to the targeted spending of 75%. Actual spending through the third quarter was $303.4 million. 26 of the 91 projects budgeted in the fiscal 23 draft CTP were within acceptable spending limits of 50 to 100%. Due to normal lags in invoicing, a plus or minus of a 25% threshold was determined to be reasonable. Attachment A details 10 projects that were budgeted for more than $11 million each in fiscal year 2023. Actual spending through the third quarter on those 10 projects was $223 million. 4 of those 10 projects are part of the I-95 ETL northbound extension group of 26 projects. Is there any questions?
Okay, it appears that there are no questions at this time.
Thank you all so much.
Thank you. Okay. We will move on to agenda item number 6, quarterly update on traffic and and revenue. And Cheryl is here. Hi, Cheryl. How are you?
Fine, thank you. How are you all? Good morning. The purpose, can you hear me? Okay, good. All right, the purpose of this agenda item is to update the Finance Committee on traffic and revenue performance through the third quarter of fiscal year 2023. Some of the key takeaways are our passenger vehicle traffic levels continue to track closely to pre-pandemic levels. The commercial vehicle traffic levels continue to outperform pre-pandemic levels, and system-wide, we exceed our forecast by 5.1% in transactions and 11% in revenue. When we adjust that for timing differences, we're actually ahead of forecast by 6.9%. As shown on the memo, let me pull that up there. Okay. As shown in the memo, for the period ended March 31st, 2023, transactions totaled 121.8 million, which is a decrease of 4.6 million over the same period last year. And our corresponding collected revenue totaled $586.3 million, or a 15.4 million, which is a $15.4 million decrease compared to the same period last year. So during the third quarter, our transactions decreased by 7.4 million and revenue decreased by 38.7 million. And this decrease is mainly due to the large transaction backlog that was processed during the third quarter of fiscal year 2022. All right, both Easy Pass and video tolls were processed at higher rates during the third quarter of fiscal 22. So our transactions were above forecast by 5.9 million and revenues exceeded forecast by $57.9 million. And that is before we adjust for timing differences. Once we adjust for the timing differences, we're actually ahead of forecast by $36 million. Let's see. The $36 million difference is actually due to an Easy Pass shift in revenue. The commuter and out-of-state, we have more out-of-state Easy Pass revenue and less commuter revenue for Class 2 vehicles. That shift gave us more in revenue than forecasted. And we collected more in video tolls, offset by a lower collection rate. So that also gave us more in revenue. And that accounts for the $36 million variance in our actual to forecasted revenue. Are there any questions?
Appears not. Certainly, this is a good report. If we're, ahead and by that number 36 million, that's a good report. And thank you for all of the work that you do, Cheryl. We appreciate it.
Oh, you're welcome. Thank you.
Okay, we will move on to the last item on the agenda is an update on the MDTA's Travel Plaza, and Simon is here. Hi, Simon. How are you?
I'm doing well, Chairman Von Paris. How are you?
Fine, thank you.
Good morning, everyone, and members of the Finance Committee. My name is Simon Ager. I'm the administrator for the Maryland Travel Plazas, and I'm here to present my annual report for the operations of the Chesapeake and Maryland houses for calendar year 2022. In the first part of my presentation, I'm going to go through a very brief background about the travel plazas, review the operations from last year. I look forward to 2023 and beyond, including the challenges that we must navigate at the travel plazas. So the MDTA is in a 35-year P3 agreement with Ares USA for the operation of the Maryland and Chesapeake houses. These welcome centers are places where travelers can rest, eat, and use the restrooms while in an environment that's safe and welcoming, full of welcoming Maryland hospitality. These houses also serve as ambassadors for our great state, and the daily charge is to provide each and every customer with a positive experience that reflects positively on our state and compel them to return. The partnership with a concessionaire whose expertise is in the restaurant trade also allows the MDTA to focus on our core strengths, which is building and maintaining bridges, highways, and tunnels. I will focus my attention to slides before you with photos from the Maryland House, which is, we can jump forward to slide 5. Just shows you some of the neat features that we have where we inform all of our guests about our great state and the contributions that we've made to America. And moving forward in the slides, and as we head up northbound on I-95 for a little road trip, we have photos of the Chesapeake House with its distinct nautical look, as well as, you can see the exterior, the woodwork, as well as the interior woodworks, which invoke imagery of a ship's bow. In the second part of my presentation, which is the meat of the conversation today, is reviewing the financial data about what's been going on at the travel plaza. So if you could move to slide 10. In that slide, we showed the travel plaza revenues broken out from 2012 through, actually should be 2022 there. Oh, I'm sorry, correct. Fiscal year 2012 through fiscal year 2021. You can see the last couple of bars that the travel plazas are slowly recovering from 2020 with the impact of COVID. The next slide shows how we are doing from a calendar year basis, which is a little bit easier to kind of review the numbers. So this chart plots out the revenue lines from 2019 through 2022. The blue line is 2019, which we're going to use as our base. You can see in 2020, huge drop due to COVID. But the interesting thing is, if you look at the purple line, which represents 2022, we were actually online or actually above in some months for rental revenue. So one thing I will mention to the committee is we did have 2 restaurants that were not open in 2022. And we also had a number of restaurants that were working on limited hours. So the fact that we have recovered shows a great mark from our concessionaire in bringing the business around. In my next slide, which is slide number 12, I've just basically are drilling down further into what do the travel plazas mean to the MDTA. So in calendar year 2022, we received $4.27 million in cash. This is money that can be deployed, for our highways, bridges, tunnels. But this shows you the impact of just 1 year for the travel plazas for the MDTA. There's also a breakout between the house revenue, which is $2.38 million, versus the impact of having Sunoco and its convenience stores, which brought in $1.89 million. If we move on to slide 13, this shows, drilling down even further, where's the money coming from? So at the Chesapeake House, you can see the Sunshine Market was the leader at $3.4 million in sales compared to 3.0 in 2021. Flip side of Maryland House, same story. Sunshine Market led the way with almost $5 million worth of sales. What this translates to the MDTA is we received 10% of all sales at the houses. If we move on to the next slide, which is number 14, there were a couple of, actually we had 6 concepts or restaurants that hit very high sales numbers. So going back from 2017 and looking forward, you can see the Chesapeake House Marketplace had $386,000 worth of sales. Same thing, we look at Maryland House Marketplace, $562,000 in sales. These were the highest marks, all monthly marks. All these highs posted in July of 2022. And what does this mean for us? This is, again, sales, and we receive 10% of all sales generated. So this includes food, your drinks, t-shirts, keychains, etc. So again, July 2022 was a great month for the travel plazas. Moving on to slide 15. In addition to generating revenue for the MDTA, being an ambassador for the state, the travel plazas are also involved with community events. We've got events at the Chesapeake House where we have the Maryland Women in Military Service Monument. There are events throughout the year where different veteran groups come out and commemorate various holidays. And at the Maryland House, we have the annual America's 9/11 Ride. This is a group of bikers. They go from Shanksville, Pennsylvania, all done on a weekend, from Pennsylvania down to the Pentagon, and on their way up to New York City, they make a stop at the Maryland House. It's been a huge, huge success. Nothing but kudos from the foundation. Aries has been doing a great job of providing baked goods, water for our riders, and literally it's like military position: 45 minutes in, 45 minutes out. And I will say this, having been out there for several years, the place is immaculate. You cannot see a single piece of trash from these bikers. So I'm really excited. We're going to have the event again this year, and I'm hoping that members of the committee and fellow MDT employees can come out on Saturday, August 19, and really appreciate the sounds and smells of and the thunder of the motorcycles coming through. Great cause. But events like these, they help to drive traffic and sales, and the aim is to expand on them, to make the travel plazas not a pit stop, but actually a destination, and then also ties back to our communities in Cecil and Harford counties. Wrapping up this presentation, as we look ahead, we're in a retail environment, and we must constantly improve the customer experience while also recognizing the challenges that environment faces. I present those on slide number 16. The first one that I've got listed here, under continuous customer enhancements, is in March of this year, all of our concepts were open 100%. So we have a burrito place called Corritos at the Maryland House, and Phillips is now open 100%. So if anyone's hungry, please stop on over at the Maryland House for a crab cake or two. And but that's been a huge positive for the travel plazas, to have staffing in place to open up all the concepts, to open up the restaurants even earlier. We do serve a diverse group of customers, from truckers to travelers. Truckers have a different schedule than most of us. So by opening the restaurants early, keeping them open longer, it's a positive for all of us. A project I'm really excited about, we currently have milling, paving, and restriping of all the paved surfaces to include all the ramps and lots and access roads at both travel plazas. That's going to be a huge success for us, because again, if customers don't feel comfortable, or if the place looks like it's not well maintained, they have other choices. It's a competitive environment. The concessionaire is also planning on restroom renovations this year. Everyone who comes into the travel plazas goes to the restrooms. That is our major focus right now, is to provide a great, clean environment. If folks don't like the restrooms, they're going to walk out. They have other choices to go to. So again, really critical. So we're making positive marks there. Looking ahead, some of the challenges, as you know from media reports, the service industries such as dining and hospitality are still having issues in recruiting, hiring, and retaining staff in a very competitive type labor market. We just don't want bodies behind the counters. We want folks who are really going to provide the excellent customer service. They have a passion for it. We also have competition, namely at the Chesapeake House, with the opening of Great Wolf Lodge. That's going to occur next month. It's a self-contained city with its own restaurants, and also they're looking to add over 700 staff. It's a very tight labor market in both Harford and Cecil counties. We also have additional challenges such as restaurant signage on I-95. where travelers can bounce off of the JFK Memorial Highway, grab a bite, and then they pop back on the highway again. Tech-savvy travelers have smartphones where they can do price shopping, and they can go from one location to the other, and that really impacts us for those customers who are very price conscious. As prices of fuel may go up, they're going to look around on various apps to see where they can get the best deal. So that could also impact us. The takeaway from this presentation is that the travel plazas have been very resilient during very challenging times, and we're moving forward. We're 100% open for business and with more hours to serve our guests. Slides 17 and 18 are just presented for reference purposes and document how the MDTA derives revenue by plaza and commodity. This concludes my presentation. I thank you for your time today and happy to answer any questions that you may have.
Chairman, if I could, I just want to jump in for 1 second here and compliment Simon and Deb on their work at the travel plazas. This is, for most of the MDTA, this is not our core business, but they take this operation very seriously. Simon, when you look at slides 17 and 18, they have a very strong understanding of how revenue generation works for us, right? Whereas, the concessionaire may have different values because their profitability is a different outlook than our revenue generation. And so there is a lot of management that actually goes into making sure that the concessionaire's operations are really in tip-top shape to benefit customers and to really provide a facility that when customers visit it, it's representative of our state. And so, from both the customer experience and making sure that this contract runs in the best interest of the state. Prior to coming into this role as executive director, I really had no idea how much attention and care went into these travel plazas. But Simon really gets it and is doing inspections regularly and absolutely cares and puts a great level of attention to detail on managing this. So I just want to compliment him to the finance committee. Just, I don't, it's not something we talk about a lot. And so while we're here, I wanted to take a moment to thank him for his work and let you see the revenue numbers. We're up. The concepts are getting more opened. There's attention to the parking lots, all these things. They don't just happen without the team, having a level of accountability there. So I want to thank them.
Thank you, Will. Appreciate it.
Well said, Will. And I had a couple of quick comments. The Maryland Women in Military Service Monument, I think that is fantastic. There are so many talented, hardworking, dedicated, exceptional women in the military as military members. One in particular, there's a Yvette Davids, is a admiral, and she's going to be the first female superintendent at the United States Naval Academy. So she's she's just been appointed, and she's going to be in there. But I really think that's neat that we're doing this. I know this is Maryland, it's Maryland Women, but it says on the monument. I think that's fantastic. And there's a lot of good, as Will just highlighted, and it points out how diverse this organization is. We're diversified. We are, where we have a police department, we have travel plazas, all these things, and this is important. And we're, in many respects, yes, it is a challenging industry. This kind of industry is challenged with labor, certainly, but it's also, I think that, as Will said, we're the revenue's up, we're onward and upward, and overall, it's like goodwill ambassadors to a degree. I know we're involved with the Boys and Girls Clubs and other things. So I think it's a good report, and thank you for leading that, Simon. Thank you.
Appreciate it, Chairman.
Thank you, Member Von Paris. And the travel plazas, when we did our revenue update, right? And we're talking about being $36 million above our forecast. And then the revenue that comes here, it's quite small in relation to our other revenue. But one of the, greatest values that we got from the travel plazas is building these beautiful structures didn't cost MDTA any money at all. So when we think about the refuge that the travel plazas provide to our travelers, which is critical for safety, MDTA toll revenue did not have to go into constructing those facilities. Instead, we were able to divert that money into our bridges and tunnels. So I think sometimes the financial value to MDTA can be misleading if we only look at the annual revenue that we receive. And then with areas, staffing that Simon highlighted, the challenges that they have faced, which we've had great times and we've had some challenging times, you can tie them back to staffing. But in that respect, they're not alone. And their commitment to the communities. Member Von Paris and Simon both mentioned that memorial. The state had been trying to construct that memorial for years and didn't have the funding. And areas volunteered to construct that at no cost to the state. And they've also, Simon, please remind me, how much have they contributed to nonprofit organizations, both by donations, cash donations as in kind? Is it over $1 million?
Yes, it is.
Since they've been our concessionaire. So they really are committed to the community that they operate within.
Oh, good news. Well, Simon, thank you again. And it leads us to the end of the agenda items. I just wanted to say to everyone who participated in today's meeting, certainly the board members, you've asked some very good questions and it was very good interaction, so important. And others who participated in answering those questions, and then also just the great effort of the MDTA team in this area in the finance side of things. And I want you to know that I'm sure I speak for the board to others here, and the appreciation that we all have for the work that you do. So anyway, is there any other comments? Anyone? Okay. Well, based on that, we will look for a motion to adjourn.
So moved.
Okay, and second?
Member Ardinger, I second.
Okay, we have a motion to adjourn and a second. All those in favor?
Aye.
Aye.
We stand adjourned.